Hey, Money Vikings, are bonds sexy again? Top five advantages of investing in bonds in this episode. Hey, thanks a lot for joining me, and I hope you get a tremendous amount of value out of our ideas and inspiration that we're bringing. So, wanted to do the top five advantages today of investing in bond funds, and I'm being a little tongue in cheek here about this because bonds are not known to be a very hot or exciting area to invest in. But what's surprising is that this year, the traditional 60-40 portfolio, where you do 60% in stock equity funds that are diversified across the S&P and 40% in diversified bond funds, has actually done quite well, which is surprising as the market over the last couple of years, or last year and a half at least, has really just sort of gone sideways and had a lot of volatility, but hasn't seen a lot of upward trajectory. We have had a few weeks of upward trajectory, but we'll see if that lasts, of course. So bonds, first I want to start with like a basic 101 on bonds. Bonds are very different from equity investments. When you're talking about a stock, when you buy a stock in Berkshire Hathaway, you're becoming a small stakeholder and equity holder in those companies' future profits and assets, right? Now, it's a very sliver, you're not really owning the company or anything, but you're becoming an equity, small equity holder in that stock of that company. And very different with bonds. Bonds is a kind of lending situation where you're almost like a small bank, right? So you're lending your money. Now, of course, the bonds trade on the market, okay? And packages of them and ETFs do, of course. But essentially what a bond is that you're lending your capital to either a municipality or to typically large companies, and it's for them to do things like capital improvements. The traditional ones are if you're lending to a city or a county or a state, they're using that money. They're collecting the bond money to build infrastructure, transportation infrastructure, airports. All kinds of stuff like that. And what they've promised is that they will, through tax revenue, of course, they will pay back the bond holders a certain amount every year, and they'll give you a certificate, a percentage return, and that can range depending on the risk factor. And then at the end, or the maturity of that bond, and they can go out long term and short term. Some can be 5 years, some can be 30, 40, 50 years. But at the end of that maturity, you get your principal back. So traditionally, bonds have been advantageous because it smooths out the ups and downs of the stock market. We all know that at times the market, like for example, when the pandemic hit, stock market dropped like a rock, 9/11, that kind of stuff. So after those types of things, you want to see things smooth out. So with that, let's go into the five advantages here, and I'll move this over of our bonds. So move that right there. Okay. Yes. So number one, you're looking at steady income. Okay. So bonds provide a regular stream of income in the form of interest payments. And this is unlike stocks where dividends can vary significantly. Bonds typically have a fixed interest rate or coupon rate that is predictable. So it gives you a sense of predictability. Now, there's still risk to these, and people do lose money with them. But again, typically, and the bonds are also rated, I should say. Some are higher quality, meaning lower risk than others. And of course, there's ones that are very high risk. They'll pay more interest, but you take the biggest risk of losing your capital investment. Second thing. So bonds are typically considered a way to preserve capital. So if you have, a lot of times older folks will use them because maybe they've saved up over the years, invested, and they don't want to stomach huge swings in the market. So what they're doing is they're preserving their capital, but they're also trying to fight back or beat back inflation a little bit. It used to be better when inflation was more 2-3%. You were beating inflation by a little bit. But nowadays, with inflation at 7-8%, hopefully that comes down. That can be a little harder. The third thing to mention is diversification. Bonds offer an effective way to diversify an investment portfolio. By including bonds alongside stocks and other assets, investors can potentially reduce overall portfolio risk. So again, what you're hoping to do is, when the market does do the sometimes tanks, you're not being hit with a 50% loss. If you have 40% in bonds, you're being hit with a 20% loss. It mitigates that big drop a little bit. Bond funds offer liquidity. It's not like a rental property or other assets that it's really hard to get the money out of it. Again, they're traded every single day, and we'll go into some of them that I like. And then again, obviously, one of the big advantages is risk management. So we talk about this a lot. If you are a person that cannot stomach seeing, if you've saved $100,000, and if you have a hard time imagining that becoming 50,000 in a few days because of some external shock or just panic on the market, then you need to know yourself. And bonds typically offer investors a way to level and smooth that out, so it's not such a tremendous drop. So those are the big advantages traditionally. There are obviously a lot of different options. So here are some of the Vanguard funds. And of course, with Vanguard, you have the great advantage of having low expenses, and that really helps you over time. But you've got the total bond market index, the total bond market ETF, tax exempt bond. Good idea. You can get your 4 or 5%, and then you're not paying taxes on it. Vanguard short-term treasury bonds, high yield corporate fund, and the ultra short bonds. And then there's international bonds, of course, as well. So something to look into, something to ask your professional advisor about, and definitely see a fiduciary about your particular situation. This is not investment advice for anybody, but just presenting some information. And that is about it. Those are the highlights there. And please, hope you enjoyed this. Hope this gave you a little bit of a primer and overview. And we do have our, on truewealth.moneybikies.com, we have our Ride the Bike portfolio that essentially, and this shows one of the bonds, this is the Vanguard Total Bond, obtained a 4.28% compound annual return right there. And of course, I wanted to go to I want to show you here our Ride the Bike portfolio has about 30% here in bonds, and that's typically what I personally keep it at. And that's things like the BLV and the VCLT, etc. Hey, take care. See you all next time. Thanks.